Michael Burry is back. The guy who predicted the 2008 housing crash and made hundreds of millions shorting the market just placed a $2 billion bet against artificial intelligence. Specifically, he's betting that Nvidia and Palantir, two of the biggest AI stocks in the world, are about to crash. And when the guy from The Big Short makes a move this big, markets pay attention. This isn't some random investor with a hunch. This is the man who saw 2008 coming when everyone else was buying. So what does he see now that we don't? Let's break down exactly what's happening, why it matters, and whether you should be worried about your portfolio. What Burry actually did. You see the filling from Sign Asset Management, Burry's hedge fund, and the numbers are massive. He bought put options worth $912 million against Palantir and $186 million against Nvidia. Put options are essentially bets that a stock price will fall. If he's right, he makes money. If he's wrong, those options expire worthless. But here's the thing about put options. They're not just expensive, they're time sensitive. Burry isn't saying these stocks might decline eventually. He's saying they'll drop significantly within the next few months to a year. That's a specific aggressive timeline. Bloomberg and the Motley Fool reported these positions. And immediately, traders started asking what Burry knows. Because last time he made a bet this confident, the entire financial system collapsed. Obviously, AI stocks aren't the same as subprime mortgages, but the pattern of massive overvaluation and irrational exuberance, that's identical. Why Nvidia and Palantir specifically? Look what happened to these stocks over 3 years. Nvidia went from a $360 billion valuation in 2023 to over $3 trillion today. That's not growth. That's a rocket ship. Palantir is even crazier, up 2,900% since early 2023. These aren't normal returns. These are bubble returns. Nvidia makes the chips that power AI. Every company building AI needs their GPUs. Demand is insane. Profits are massive, and the stock price reflects that. But Burry's argument is simple. The current price assumes Nvidia will maintain this dominance forever, that AI demand will never slow down, and that no competitor will ever catch up. All three assumptions are questionable. Palantir is even more speculative. They sell data analytics software to governments and corporations. Solid business, but their valuation implies they'll become bigger than most tech giants. Burry's looking at the numbers and seeing hype, not fundamentals. And when insiders at both companies sold over $9 billion worth of their own stock in the last 2 years, that tells you something. The people running these companies are cashing out at prices they don't expect to see again. This isn't just Burry. Stanley Druckenmiller, one of the greatest investors on Wall Street, already sold his entire position in Nvidia and Palantir months ago. He bought early, rode the wave up over 1,000%, then got out completely. Where's he putting his money now? Pharmaceutical companies making weight loss drugs like Eli Lilly and Viking Therapeutics. That's not a random pivot. That's a guy who sees the AI trade getting crowded and overvalued. He took profits and moved to something with actual growth potential that isn't priced for perfection. When both Burry and Druckenmiller are on the same side of the trade, even if they're using different strategies, you should probably pay attention. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, also warned that AI valuations are bigger than the dot-com bubble. Joe Tsai, co-founder of Alibaba, said the same thing. These aren't pessimists or people who don't understand technology. They're investors who've seen this pattern before and know how it ends. The dot-com comparison everyone's making. Early innovation starts with a bubble. The internet in the late 1990s, railroads in the 1800s, even tulips in the 1600s. The pattern is always the same. New technology emerges, everyone gets excited, valuations go insane, then reality hits and most companies collapse. The technology survives, but most of the companies don't. Sam Altman, CEO of OpenAI, literally admitted in a CNBC interview, yes, we're in an AI bubble. But that's normal. Every major innovation starts with enthusiastic speculation. He compared it to the dot-com bubble and said the most important question is what survives after the bubble pops. That's a stunning admission from the guy running the company at the center of the AI boom. He's not saying there's no bubble. He's saying bubbles are fine and we'll figure it out later. That should concern you, not reassure you, because the dot-com crash wiped out trillions of wealth. Amazon and Google survived, but Pets.com and Webvan didn't. Who's the Amazon of AI? And who's Pets.com? Nobody knows yet. The numbers behind the panic. You see the recent market action, and tech stocks are bleeding. Tesla down 5%, AMD down 4.95%, Nvidia down 4.09%, Meta, Amazon, Google, Microsoft, all red. This isn't a one-day dip. This is sustained selling pressure from institutional investors who are getting nervous. Google searches for AI bubble hit an all-time high in November 2025, according to Cyber News. When retail investors start Googling whether they're in a bubble, you're usually already deep into the bubble. Regular people don't worry about bubbles at the beginning. They worry when prices have already gone parabolic and they're scared of missing out or losing everything. Market cap tells the story too. Nvidia hit $5 trillion in valuation. For context, that's more than the entire GDP of most countries. Is any single company worth more than the economic output of Germany or India? Maybe, but probably not. And when you see valuations this extreme, downside risk is massive, even if the company is great. The OpenAI controversy. This is where it gets really interesting. OpenAI's CFO, Sarah Frier, said at the Wall Street Journal conference that the US government might need to support AI companies if they face financial trouble due to massive infrastructure spending. Essentially, she implied AI companies might be too big to fail and could get government bailouts. The backlash was instant. Sam Altman had to clarify that OpenAI doesn't want government guarantees and won't ask for a bailout if it fails. But the damage was done. Means someone inside OpenAI is worried about their financial trajectory. Look at OpenAI's numbers. They expect $20 billion in revenue this year, but they lost $12 billion in just the third quarter. They're planning to spend $1.4 trillion on AI infrastructure through 2033. That's more money than most countries spend on anything. If they can't turn that spending into sustainable profits, the whole AI investment thesis collapses. And if OpenAI, the leader in AI, is burning money this fast, what does that say about everyone else chasing the same market? What this means for tech stocks? The fear isn't that AI is fake or won't work. It's that current prices assume perfect execution, infinite growth, and no competition. Reality is messier. Nvidia might face competition from AMD, Intel, or custom chips from Apple, Google, and Amazon. Palantir might lose government contracts or fail to expand in commercial markets. OpenAI might never figure out how to make their models profitable. Every scenario where these companies don't achieve godlike dominance results in massive stock price declines. And those scenarios aren't unlikely. They're normal. Most companies don't maintain 100% market share forever. Most revolutionary technologies eventually commoditize. The companies making shovels during the gold rush made money, but the gold miners mostly went broke. Analysts from Future & Group argue that some AI companies have real fundamentals and will survive. Nvidia has actual revenue, actual profits, and actual products people need. But even good companies can be overvalued. Cisco was a great company in 2000. Their stocks still dropped 86% in the crash and took 17 years to recover. You can be right about the company and still lose everything if you buy at the wrong price. The bull chase nobody wants to hear. Here's the controversial take. Burry might be early or wrong. He was early on the housing crisis too. He placed his bets in 2005, but the crash didn't happen until 2008. He was right eventually, but betting early in markets is the same as being wrong if your options expire before you're proven right. AI is real. The technology works. Companies are integrating it into everything. Nvidia's chips are genuinely revolutionary and years ahead of competitors. The demand might justify the valuation if AI becomes as transformative as the internet. And unlike the dot-com era, these companies have actual revenue and profits, not just promises. Maybe this time is different. Maybe AI grows fast enough to justify trillion-dollar valuations. Maybe Nvidia maintains 80% market share for decades. Maybe Palantir becomes the operating system for every government and corporation. It's possible, but investing based on best-case scenarios is how you lose money. The probability-weighted outcome matters more than the dream scenario. What you should actually do. If you own Nvidia or Palantir, don't panic sell because one guy placed a bet against them. Burry has been wrong before, but you should ask yourself, did I buy these stocks because of fundamentals or because they kept going up? If your thesis is number goes up, you don't have a thesis. You have hope. Look at your position size. If these stocks are 5% of your portfolio, you're fine. If they're 50%, you're taking massive concentrated risk in the most crowded trade in the market. Diversification exists for moments like this. When everyone owns the same stocks and the narrative changes, the exits get crowded fast. Consider taking some profits if you're up significantly. You don't have to sell everything. But if you bought Nvidia at $200 and it's at $500, maybe sell half and lock in gains. Let the rest ride if you believe long-term. This way you win whether Burry's right or wrong. You de-risk without completely missing out. The bigger picture. Burry's bet isn't just about 2 stocks. It's a statement about the entire AI sector. If Nvidia and Palantir crash, the whole AI narrative gets questioned. Smaller AI companies with no revenue will get destroyed. Even tangentially related tech stocks will sell off. This could trigger a broader correction in markets that have been driven by AI hype for 2 years. The timing matters too. Markets are already shaky. Interest rates are still elevated. Consumer spending is slowing. Earnings growth is decelerating. AI stocks have been the only thing holding up the market. If that narrative breaks, there's nothing underneath to catch the fall. That's what Burry is betting on. Not just that AI stocks are overvalued, but that they're the pins holding up the entire market structure. And here's the really uncomfortable truth. Even if AI is revolutionary and changes everything, that doesn't mean buying stocks at any price is smart. The internet changed the world. Buying internet stocks in March 2000 still destroyed your wealth for a decade. Being right about the technology and wrong about the timing or valuation is the same as being completely wrong.